Taking a look at the final numbers after the stock market closed just about 45 minutes ago. The Dow down about 349 points. We've watched just a roller coaster of responses after President Donald Trump imposed a new wave of reciprocal tariffs last week and threatens more on China today. But what does this mean, right, for you at home? Your efforts to save for retirement, paying down debt, or maybe just keeping up with rising prices at the grocery store. This evening, I'm joined by Mark Hamrick, Senior Economic Analyst at Bankrate. Mark, thanks so much for joining us tonight and really just trying to help us understand what exactly we're watching with the markets. Good to be with you.
Good to be with you, Simone. Thank you for having me.
Yeah, let's dive right in here. So just, in basic terms here, what does it mean when we say the stock market is volatile? It's going up, it's going down. Should people be worried in general, just regular everyday people?
Well, I think people are worried. I don't think there's any question about that. When you have 20% taken out of the S&P 500, the market's main benchmark, which is what we achieved earlier in today's session, you qualify with the definition of a bear market. So we had stellar returns in the market over the previous 2 years, and to have this extent of a decline in 3 days is really the stuff that you see during severe market declines. We're thankful that we ended off the lows of the day today, but I think we need to be strapped in for more volatility going forward.
Yeah, certainly more of a moderate day that we saw at the closing bell. Just curious, you did mention a bear market. Are we in a bear market, and what exactly does that mean?
The definition of a bear market is a 20% decline in the major averages from the market top, which we saw in February, and we achieved that level early today. So the S&P 500 is the main market benchmark. That's what most people use for mutual funds, exchange traded funds. It's an index of 500 large stocks, basically the best in the business. And that really is where most people's fortunes are made when they're saving for retirement. And so 401ks being the primary vehicle for that, most people have significant exposure or investment in an S&P 500 fund. And so early in today's session, they had seen a decline in the S&P 500 of 20%.
To that point, a lot of people have their retirement savings in a 401k, as you've touched on, or in an IRA. When we see the market drop, people get really nervous, understandably so. What should people be doing? Do they stay the course? Do they make changes? What would you advise?
Well, first of all, let's think about the fact that the market has come down essentially 18% now from the high since we recovered some of the lost ground through today's session. It's very difficult to be right twice in the sense of when to get out of the market and when to get back in. And history shows that most people aren't able to do that. For people, and that's the majority of investors who have a very long investment time horizon, many years before they're going to need these retirement funds, they should really try to ride this out. And particularly for younger people who have decades to go, not only to that destination of the last day of work, but to the last day of their lives when they will need this money. And so for people who are either currently retired or looking at retirement in the near term, they should probably talk to an investment professional to see whether they should dial down risk. But you may have already suffered the brunt of the damage. So to get out now might lose out on some buying opportunities. We just don't know where the market will go from here in the near term.
All right, then this next question, I'm still going to ask it to you. Bottom line, should Americans be bracing for a recession, or are we just too early to even really be able to tell that right now?
There's no question, Simone, that the risks of a recession, let's say out over the next 6 to 12 months, have risen significantly. We asked the question of economists in our quarterly survey at Bankrate just a few weeks ago, and they put those odds then up from the fourth quarter of last year up to more than 1 in 3, or a 33% chance, but that was about 2 weeks ago. Now, if you survey Wall Street firms, they're putting the odds at about even, 50-50. And so what does that mean for the rest of us? It means that there is a chance that there will be an economic downturn. There can be more unemployment, more people losing their jobs, interruptions in income. And so one way to prepare for that possibility is to prioritize emergency savings. This is savings that goes into a high yield savings account so that if we have a problem like this going forward, we have more money in the bank. And most Americans live paycheck to paycheck. Our Bankrate surveys have found that out year after year. And so not only to continue to invest for retirement, but also also to fund that emergency savings fund and to pay down debt. Those are three things that you will not regret if you continue to do that, whether there's a recession in the near term or not.
All right. Mark Hamrick, Senior Economic Analyst at Bankrate. Thank you for trying to help make sense of all of this with us. We certainly appreciate your time tonight.